Imagine waking up tomorrow morning, opening your phone, logging into your bank account, and discovering that your bank is collapsing. Your money is still there, but suddenly you're not sure if you'll ever be able to withdraw it. For thousands of companies and investors, that nightmare almost became reality in March 2023. In just 48 hours, a single bank failure triggered one of the fastest bank runs in American history. Billions of dollars were withdrawn. Startup founders panicked, investors scrambled, and the entire U.S. banking system began to feel the shock. If regulators had waited even one more day to intervene, the consequences could have been catastrophic. Today on Capital Thesis, we're breaking down the 48 hours that almost crashed America's banking system. And by the end of this video, you'll understand something most people still don't realize. The weakness that caused this crisis still exists inside the banking system today. So if you want to understand the hidden mechanics of money and power, make sure you subscribe to Capital Thesis. Because this channel exists to explain the financial systems most people never see. Now let's start at the beginning. The bank at the center of this story was called Silicon Valley Bank. For decades, it quietly powered the technology startup ecosystem. If you were launching a startup in California, there was a good chance your company banked there. Venture capital firms used it. Tech founders used it. Startup employees trusted it. At one point, nearly half of all venture-backed startups in the United States had accounts at this bank. But that created a very unusual situation. Unlike traditional banks filled with everyday customers, this bank held enormous corporate deposits. Millions of dollars, sometimes hundreds of millions, and that created a hidden vulnerability. Because in the United States, bank deposits are only insured up to $250,000. Anything above that amount isn't guaranteed if a bank fails. But at this bank, most companies had far more than that sitting in their accounts. Which meant if the bank ever collapsed, billions of dollars could disappear overnight. At the time, nobody thought that was possible. But then the economy changed. During the pandemic, something unusual happened in the startup world. Tech companies raised massive amounts of money from venture capital investors. Funding exploded. Billions of dollars flooded into startups. And most of that money ended up sitting inside accounts at Silicon Valley Bank. Deposits at the bank skyrocketed. Suddenly they had tens of billions of dollars that needed to be invested somewhere. Because banks don't just keep your money sitting in a vault. They invest it, usually in loans, mortgages, or financial assets. So the bank made what seemed like a safe decision. They bought long-term U.S. government bonds. At the time, interest rates were extremely low, and government bonds were considered one of the safest investments possible. But then something changed. Inflation surged across the United States. To fight rising prices, the Federal Reserve began rapidly increasing interest rates. And when interest rates rise, the value of older bonds falls. Suddenly the bonds that the bank had purchased were worth billions less than what they originally paid. On paper, the bank was now sitting on massive losses. But as long as customers kept their money in the bank, the situation could remain stable. The losses were only theoretical. The real danger would appear if too many customers tried to withdraw their money at once. And that's exactly what happened next. On March 8, 2023, the bank made a public announcement. They revealed they had sold part of their bond portfolio at a loss, and they needed to raise new capital to stabilize their balance sheet. To experienced investors, that announcement sounded like an alarm. Something wasn't right. Within hours, venture capital investors began contacting startup founders. Private messages started spreading through Silicon Valley. Group chats exploded with a single warning. Get your money out, immediately. What happened next spread faster than any banking panic in modern history. Startup founders rushed to withdraw their deposits. Investors called every company they had funded. Social media amplified the fear. Within a single day, customers attempted to withdraw more than $40 billion. That amount of money had never been withdrawn from a bank that quickly in U.S. history. And the bank simply didn't have the cash. Because like most banks, it had invested most of its deposits. Executives tried to calm investors. They issued statements. They reassured customers. But panic had already taken hold. The following morning, regulators stepped in. Silicon Valley Bank collapsed. In just 48 hours, one of the most important banks for the American startup economy had failed. But the real danger was only beginning. Because the collapse triggered fear across the entire banking sector. Customers at other regional banks began asking the same question. Could our bank be next? Bank stocks started falling rapidly. Withdrawals increased at multiple institutions. The possibility of a nationwide banking panic suddenly became very real. That's when the US government moved quickly to contain the crisis. Over a single weekend, officials from the Treasury Department and the Federal Reserve held emergency meetings. Their biggest concern was simple. If Americans started losing trust in their banks, bank runs could spread across the entire country. So regulators made an extraordinary decision. They guaranteed all deposits at Silicon Valley Bank, even deposits far above the normal $250,000 insurance limit. It was an attempt to stop the panic before it spread further. And for the moment, it worked. Markets stabilized, withdrawals slowed, the immediate crisis was contained. But the collapse revealed something deeply uncomfortable about the modern banking system. Because the weakness that caused this crisis still exists. Most people believe banks simply store their money. But the reality is very different. Banks operate using something called fractional reserve banking. They keep only a small portion of deposits available as cash. The rest is invested. This system works perfectly, until too many people ask for their money at the same time. Then even healthy banks can collapse. And in the age of instant mobile banking and social media, bank runs can happen faster than ever before. Silicon Valley Bank proved that $40 billion was withdrawn in a single day, a speed that would have been impossible just 20 years ago. Which raises an uncomfortable question. What happens if the next bank run is even larger? The collapse of Silicon Valley Bank wasn't just a story about one failed bank. It was a warning, a glimpse into how fragile modern financial systems can be. Because banks ultimately run on one thing. Trust. The moment that trust disappears, even the largest financial institutions can collapse. And in a world where information spreads instantly, panic can travel faster than regulators can react. Which means the next financial crisis might unfold faster than anyone expects. If you want to understand the hidden systems that control money, power, and the global economy, subscribe to Capital Thesis, because the deeper you look into the financial system, the more surprising it becomes. And in the next video, we're going to uncover another shocking financial story, the hedge fund trade that almost broke the global financial system. Trust me, that story is even more unbelievable.